Your IRA or 401k can invest in a real estate syndication. That's right, your broker-dealer IRA that's buying mutual fund or stocks can actually be invested into an LLC or limited partnership, buying multifamily or other commercial real estate with a group of other investors. This is one of the most popular ways people have been investing to build and grow wealth. Now, I know you might be thinking, Matt, I never knew an IRA or 401k could own real estate, let alone a syndication. Can't it just own publicly traded stocks and mutual funds? No! Your IRA can own publicly traded stocks and mutual funds, but that's not all. Now, if you have an IRA with a broker-dealer like TD Ameritrade or Fidelity, they're going to let your IRA invest in what they sell. They sell stocks, bonds, and mutual funds. They're broker-dealers. That's the stuff they sell. If you want to buy a real estate in a syndication or on your own, you have to use what's called a self-directed IRA and work with a self-directed IRA company. There's 20 companies out there that offer these so-called self-directed IRAs. I happen to run the best company, Directed IRA, wrote the #1 book in the business. And every 10 or 20 minutes, some investor with an account here is investing in a real estate deal with their IRA or old employer 401k funds. I'm going to go through the 3 steps you need to know on how your IRA or 401k can be invested into a syndication. Step 1, you're going to need a self-directed IRA. So if you've got that IRA, or maybe it's an old 401k from a prior employer where you can move it. You're not locked down in the 401k plan because you don't work there anymore. You can move that from the broker-dealer over to a custodian that lets you invest with a self-directed IRA. Now, this could be a Roth IRA, a traditional IRA, a SEP IRA. I'm just using the word self-directed IRA in general so you know that that IRA can be directed into the investments you choose, not what's on a menu at a broker-dealer's office. Now, that transfer or movement, there's no tax, there's no penalty. It's still an IRA account. It still gets all the great benefits of IRAs. Now, once your money has been moved over into the self-directed IRA, you have completed step 2. And your account is now funded. Now, typically you would have sold your IRA or 401k to cash and then transferred over that cash into that new self-directed IRA. Then step number 3 is you're gonna authorize the investment. Most self-directed IRA providers have a direction of investment or investment authorization that says, hey, invest my IRA into XYZ LLC fund. Now, in addition to your written authorization, where you're gonna give the wiring instructions for the firm and where to send the money, you're also gonna need to provide the investment documents. This is the offering memorandum, the subscription agreement. And by the way, on that subscription agreement, when it says the purchaser or investor, that is not you, that is your IRA. So for example, if I was filling this out for myself, the purchaser would be Directed Trust Company, FBO, Matt Sorensen IRA. It's not Matt Sorensen's the purchaser. The purchaser buyer subscribing to the units is your IRA, so you need to list it in the name of your IRA. Now, a common question we get there is, how do I know if my IRA is an accredited investor? Some funds require an accredited investor. Well, if you personally are an accredited investor, $1 million of net worth, not including the equity in your home, or $200,000 annual income if you're single, $300,000 annual income if you're married. But if you personally are an accredited investor, your IRA is accredited. Now, in some funds, you don't have to be an accredited investor, but if that's part of the process, typically you get an accredited investor questionnaire. So that's it. Now, your IRA owns the fund, it's subscribed, it gets the cash flow, it gets the gains when the property sells. And now your IRA owns commercial real estate, whether that's multifamily, self-storage, retail, doesn't matter the type. Your IRA is now invested into commercial real estate. Now, there's a tax consideration you're going to want to know about in this process. Now, typically when we think of our IRAs, remember the cool thing is I'm getting rental income in my IRA, I don't pay tax, and as the property sells, I don't pay tax either. But if the purchase of assets from your IRA was leveraged with debt, you do pay a tax called UDFI. Now, the easiest way to understand this is just thinking of a single family rental. It applies in a syndication or in any private fund in the same way, but this is a tax called UBIT or UDFI. Let's say you bought a property for $100,000 and you did this with your IRA, and I'm using 100K just so I can do the math here. Now, let's say your IRA threw $40,000 into the property and it got a loan for $60,000. Now, when the IRS looks at this property, they say, okay, cool. Your IRA bought $40,000 worth of assets. The other $60,000 came from debt. We'll let your IRA get the benefit of it, but we're going to tax the profits from the debt piece. That was not IRA money. So if you have $10,000 of net income, this is after expenses, you're going to pay this UDFI tax. And this happens at the IRA level, and your IRA ends up filing what's called the 990T tax return. So just stay with the example, hear me for a moment. Let's say this was the sale of the property. And after all the expenses and write-offs, there was $10,000 of taxable gain going to my IRA. Now this is whether my IRA owned the property outright, or this is whether I'm getting a K-1 from the syndication for $10,000 from the sale of the property. Now what the IRS does is they look at what's the leverage ratio of the property here. If the property is 60% leverage with debt, 60% of the gains will be subject to this UDFI tax. So in this example, 60% of the gain, $10,000, is $6,000. Now the tax on the sale of the property, you do get capital gains rate of 20%, which means you'll pay $1,200 in tax. So on the sale of this asset, I'm gonna get $10,000, $1,200 is going to tax, and the retirement account is gonna keep $8,800. Now, this is the case whether it's a leveraged multifamily deal where you're in a syndication or a private fund. Same thing if your IRA bought a single family rental that was leveraged with debt. In either instance, this UDFI tax is gonna be due. Now, it could also be due on the rental income. We just rarely see that because even in single family rentals or in syndications, you're gonna have depreciation added in, of course, mortgage interest, and after all these expenses, your K-1s or your net income is typically zero, or you're gonna have a loss. And because of that, we rarely see a UDFI on rental income. But where I've typically seen it over my career is on the sale of an asset when there's still debt on it and the gain is coming through to the IRA. Now, a lot of people say, man, I don't know, I wanna invest my IRA because of this UDFI tax if it's a leveraged deal. Well, I'm not of that opinion. Let's look at the overall gain. What has your IRA or 401k been doing in the mutual fund or stock it's been investing in? They don't let you leverage and buy more assets than your IRA could otherwise buy. But if I'm doing it in the real estate market, I get the benefit of debt leverage. It's driving more overall return to my retirement account. Yes, there's a tax on it, but that was leveraging the purchasing power of my retirement account, whether it was a syndication or fund doing that, or whether I'm doing it with my IRA buying my own property. Now, there's a number of exceptions to this. If you pay the loan off, have no debt on it, and sell the property 12 months later, there's no UDFI to calculate the time of sale, so you get out of it. If you're using a 401k or other retirement account, there's no UDFI tax on leveraged real estate in that example. So there's a number of exceptions and loopholes on this, but you need to know about UDFI when you're investing in syndications that are leveraged with debt. Now, the last exception here is actually the most important for syndications is any syndication that is a REIT, and those are getting very popular now, even in smaller private funds. If they are taxed as a REIT, they are automatically exempt from UBIT or UDFI, so you don't need to worry about this. All right, well, that's the 3 steps you need to know when investing your IRA or 401k into syndication, along with the important tax tip at the end. Please subscribe to the channel to learn more about investing your IRA or 401k into alternative assets. We'll see you next time.